Meme coins are getting extended by now, and you should be thinking to yourself, what is my next step? Well, that is, of course, if you have some gains. Hopefully you have gained some now. So today I'm going to dive deeper into the art of taking profits. If you want to take your skills to the next level, how to take profits and book in those beautiful gains, so stay tuned until the end, because of course, just like every time, I'm going to show you a real live example by the end, all right? Just a small bonus, a real live example of how we apply in real world the tactics that I'm going to teach you today. Welcome back, everybody. Jomo is here, and this is the No Edge, No Trade channel where we talk about everything crypto and trading. If you recall, this is series 2 of a episode I started a few days ago about the meme coin craze and about how not to lose money. And my thesis was I was talking about how not to lose money while everything is booming right now, specifically meme coins, of course. So I wanted to make sure that people, you, my beautiful viewers and audience, understand and make sure you are presented the thought process of what you should be aware of in order to not make those mistakes, those pitfalls that people tend to do over and over again in these types of times, and to actually book those profits. So I'm going to recap those in just 1 second, but today I'm going to dive deep into the second one, all right? And the second one is the most important, I believe. Well, not the most important, but all three are important, but really important, and that's why I want to touch base about it today and go a little bit deeper and teach you the tactics that you can utilize to book in those profits, right? So let's just a small recap from the last video. I talked about 3 pitfalls that people do that might impinge their gains and actually take them back to a boom and bust, trader. If that's you, maybe give me a comment in the section below. I love those comments, and subscribe, and boom, that bell notification. And remember 3 things. 1, don't FOMO, right? Don't chase price. I said, if you have an edge, you see something that you can take as a trade over and over again, and it will yield positive results in the long term consistently, that's an edge. If you don't have an edge, you don't know what you're doing, you're probably chasing price. So don't chase price. FOMO, really a known one. Second was taking profits into strength, or taking profits, and we're gonna talk about this today. And the third one was progressively expose yourself into the trade, meaning you don't need to go 100% of your trade in just one spot. You can take a few, if you want 20% of your entire capital in one trade, for example. You can start with 5, then add another 7.5, then add another 5, and then maybe another 2.5, and then you have the 20%, and you incrementally pyramid it on the way up. And remember, never pyramid on the way down, never. That's the worst mistake traders do, so pyramiding on the way up, right? So that's from last week. This week, all right, so we're gonna focus on the second principle, and this part is crucial for traders, right? It's really crucial because it's just so annoying to see how you make gains, right? You make gains and I forgot all about my presentation. I forgot about I need to do this. Don't FOMO. I need to take profits. I need to do progressively expose, and boom, we want to go into the take profit section. And too bad. Anyways, so it really hurts. It really hurts to see those profits erode, then all go all the way back down to your break even, and you just think it's going to go back up, and then it goes down and you're in a loss, and then your ego starts to, talk to yourself, it's going to go up, don't sell, it's at a loss. Are you stupid? You're not stupid, you're right on this trade, so keep holding it to the moon, diamond hands, and then it keeps going down, and then you go the cycle of that market psychology cycle where you go from being euphoric all the way to depressed and angry, and then you capitulate, and that's usually bottom. That's not what we want for you, right? What we want is to make sure that we use and utilize good tactics to take profits. And no, you are never gonna catch the top. I'm sorry if this is a myth bust for you. Some people think that they can just magically know and predict what's gonna be the top. No, many times I buy coins and I sell them shy, doing 3, 4, 5, and 6x, but I made 100x. But I make 100x multiple times on different types of coins, and that's why I'm consistently profitable. But people that just hold usually lose over time because they don't know when to sell. So, diving into today's lecture, all right, presentation, taking profits. You have two methods of taking profits, right? The first one is into strength. This is what I like to utilize most of the time, and I think that if you're a beginner trader, this is certainly what you need to aspire to. And remember the one good thing, if you take profits into strength, you know what's good? You always have your P&L at the highest points. Always highest. Why? Because you're taking profits into strength selling, getting out of the position. Doesn't matter if it continues. It doesn't matter, right? Boom, you booked profits. Taking another trade, boom, 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 up again. Another trade, boom, selling the profits, boom. Again, it doesn't matter if it goes higher. It doesn't matter. What matters is that you book profits that are multiples of your risk. And this takes me into the tactic of how to do into strength, because this is the idea, right? So how you do this exactly? Well, you have a few methods. The first method is R multiples. So, R multiples is risk multiples. So let's say you have a trade and you have a stop loss of 10%. Right, that's your stop loss. Always protect. I talk about this about all my videos. All right, all my videos I talk about risk first. So you have 10% risk, perfectly fine. A bit wide, but that's okay. It's crypto, so you can the reward pays for the risk. And what you want to do is start taking profits a little bit at 10%, which is 1R, 2%, the 20%, which is 2R, or maybe you want to do it 1.5R, which is 50%, 30% is 3R. 35%, 3.5 bar, you get the idea, right? You want to start taking profits into strength. You can leave a runner, you can leave 20% of the position to try and whatever, and I'm going to talk about how you combine two of the ideas today, and I'm going to talk about this in the end, but just focus on selling strength. 10, 15, 20, 25, 30, 35, 50. Leave the last one to really high. Yes, it can go to 100, 200, and 300%. Doesn't matter. You want to trade, you want to be consistently successful. This is what you need to be doing. Taking profits into strength. So R multiples, or, right, that's one way. Or you into strength, you can do after a certain percentage. Instead of R multiples, you can do, I want to do every 5, 10, 15, instead of, thinking like in R multiples, you could just think in percentages. So that's one thing. I adore this tactic. I used it for many, many years. I still use it to this day. And it helps you to take off from your mind when to sell, because this question of when I'm going to sell, it hurts the mental capital so much. Create a trade, trigger it, put the stop loss, put the take profits, and set and forget. You can go to sleep. It doesn't matter what a trade does. It stops you out. You're protected. It takes profit. You sold it to strength. Boom. Doesn't matter, right? Doesn't matter. Beautiful. Number 2, just sell after a few days. So some people I know, they just sell after 3-5 days. They sell 25%. They sell 30% of the position, maybe 50% of the position. And then after 10 days, if it goes higher, they sell another. So that's another methodology. I don't like it as much, but some people use this methodology, right? Is it bad one? No. At least you're taking profits into the strength that is happening. I prefer the first one, but by all means, this is another tactic you can utilize. So, second idea. The first one was, of course, into strength. Now we're talking about into weakness. What does weakness mean? If strengths mean on the way up, weakness means on the way down. And basically, the term for it is trading your stop. Okay, so how do you trade your stop? The best way to trade a stop, in my opinion, is to use moving averages. Now, if you don't know what moving averages are, that means you're really a beginner, and that's perfectly fine. We all have been in your position. Moving averages, just short, are technical indicators you can use on your chart, on your technical analysis, on your price action, that they follow the price and they create lines, right? They create lines. That's in a nutshell. Now, the good thing about price many times is that if you use the good moving averages, let's say the 10 EMA, the 20 EMA, or the 50 EMA, many times on a swing move, the price will slide on it, will surf on it. So if it breaks down below it, then you know it's time to get out. You trail the stop below the moving average. That's one beautiful tactic, beautiful, utilized by huge amounts of traders, really successful ones, and you can make millions of dollars just buying breakouts and selling, with a trading stop. That's it. Now, B is, with the second one, is below a technical level. And I want to show this in the end, as I said. But below a technical level means instead of trading below the moving average, what happens is many times you get a move up. Let's say you bought a breakout. Then you have a small correction. Then a continuation, right? So below that price, you're going to have a technical area to put the stop. Because if it got supported, the price got supported at this area and created and moved up, broke out from that last local high and then moves back down, that means the probability of the trade to fail is high. So that's another way to trade your stop. And again, I'm going to show this by the end. Hopefully I'm going to go faster. So number 3, all right, is a combination of the two. For example, you can sell 30%, 50% after 3, 4, 5 days. I know some people do that. And the rest, just trade your stop, either with a moving average or by a technical or by both. Doesn't matter. At least use some of these tactics. Sell into weakness, sell some into strength, sell some into weakness, and that's it. I think that a combination is perfectly fine. Sell at 10, 15, 20, 25%, book 50%, sell 50% of your position already. You are in profit. You finance your risk. You don't have any risk. Even if the position goes south against you, your finance, you get stopped out still at a profit, which is amazing. When if a position goes against you, you're still in profit. And you can sell a stop as well. So you go up, sell strength, and then it moves high. Maybe it goes 400%. You didn't sell any, but you tracked it, you trail it with a moving average. Then it goes down, break below, close below it, boom, you sell, you are out of the position. Mwah. Beautiful, beautiful combination. So these are the 3, all right? Small recap. Into strength, R multiples, or after specific percentages, or after a few days, your choice. Into weakness, meaning trading, you can use moving averages, you can use technical levels, or number 3 is a combination of both. So for the example, what I want to do now is to show you a trade that we took in our trading service just a week or 2 weeks ago, and it is called Pepe. Pepe, beautiful trade. This is it. We took it at the breakout of this level, as you can see over here. This was a trade above the 00009. And as you can see, this was on the 13th of May. On the 14th, it broke out of the range, right? This broke out of the range. So what I want to show you now is how we took some profits into strength, or how you can take profits into strength, and how you can trade your stop. So first of all, what it does, I don't want to take profits just yet because it's still within the base. If you don't know what a base is, this is a base. A base is a digestion of profits after a big move up. And of course, Pepe had a huge move up from the lows, right? 700% and more. So this was beautiful. Within the base, I don't take profits. I wait for it to go out of the base. So if I go another day, boom, get out of the base. But third day, it halted around the breakout area and needed some more time. As you can see, it got back to our break even. This was a good place to add, by the way. And if I didn't mention it, always a stop loss at the low of the day. This is the stop loss. And what we can do here is put this in red. And you can add here if it breaks above yesterday's low. So if we would have break, and that's what I did, if we would have been, yesterday's high, if we break above this candle, all right, above it, so that means you can add to the position and put your stop below the low of the day. Look what happened the next day. Boom, we broke out. I added to the position here, and I moved the stop of the entire position, right, over here. So right now, I almost have no risk on the first entry, and I have some risk on the second entry. But as you can see, that doesn't matter because from now on, it just moves up, right? So as you can see, right now, you had a small correction. First of all, you can see moving averages. This is the 10-day EMA, the blue one. The yellow one is the 20-day EMA, and the red one is the 50-day EMA. Now, this is, as you can see over here, this is trading around the 20 yellow one and a little bit above the 10. Let's say we want to go above the 10. So what we do is we trade around the 10. We can move now the stop loss at this day to at least to our break-even point over here or below this wick over here or below the day of the breakout here, and it's below the 10 EMA. Lo and behold, you have some sort of technical level and some short, right? And you have the EMA stop, and you move. Right now, what happens? Let's say we go down. Let's say that's it for the trade, and it goes down and stops you out. What happens? Did you lose any money? No. Did you lose your life? No. What happened? You booked profits on a trade that went south. Now, can it jump from here up? And you'll be crying, oh my God, I was in this trade and this stopped out. Yes, you'll be crying. And that's okay. Why? Because this happens every now and then. But once you use good tactics, even if this happens every now and then, this won't happen on the really good trades that make huge amounts of percentages. You're gonna book profits on them for a lot of money, millions of dollars, right? And you're not gonna be losing money on trades. So you're gonna make a lot of money on the good trades. You're not gonna lose money on the trades that fail because you have good tactics. And boom, voila, you have a nice strategy when to get in and when to get out, how to trade, how to take profits into strength, and so on and so forth. So this is one way to stop, right? To move the stop to break even and so on. And we didn't talk about taking profits into strength. And by the way, this was, this was not it. So the first initial stop we had from our entry was around 9%. So what do I want to do? I want to take this and start measuring from here. What's 20%, 20 something percent? I see that at 50% I'm only above the base. So what I do is I use this, and in this I want to take profits around 10% above the base itself at least. So this is above the base, and voila. You can take a 20%, let's say you took some profits over here. Let's say this was a take profit area over here. This is it. You made 20% from the high, all right? From the high. But from your own entry, you actually made already 40 something percent. Look, and look what's happening. This is going to continue. Boom, 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 boom. Now what happens, right? Now what happens? You can as well put you can put more take profits. That's perfectly fine at 45, 50, and so on. And you can move the stop to below this area. Look, a technical area, because we had a small correction and then continued, and as well as below the 10 EMA. So booking profits more and more, and I'm taking profits here, I'm taking profits here, I'm taking profits here, I'm taking profits here, and I'm trading the stop. This is how you do it on a real live case. Beautiful trade on Pepe. We took it on a trading service, and by the way, if you watched it so far, it means that my content interests you. So first, subscribe to the channel. Give me a like. Give me a comment in the section below because it helps the algorithm. And it seems that you really want to improve your trading because you watched already 18 minutes or so. Why not try me out on our trading service? I promise you it will be worthwhile to at least try me for 1 month. The small tier, $25, try me. If you want more, that's up to you. What you need to do is click on the link in the description or in the first comment section below. Take you to the website, Patreon, choose the tier, enter, and start going and trading with us. Of course, I do the heavy lifting for our group, daily market updates, weekly study sessions, tips, and of course, signals when to get in, when to get out, and so on and so forth. All right, everyone, I hope this information was beautiful and you loved it. Well, I hope so. I don't know if you loved it, but at least it was informative. At least, did you like it? This is good. Is this good? You can make millions with this strategy. Point blank. You can make, not millions, hundreds of thousands. Not hundreds, tens of thousands. You can make a lot of money trading this. Of course, it will take you a few years to make multiple millions, but hey, you have this. And these are good sound tactics. Why to use just FOMOing and entering and I don't know who is telling you when to enter without any good sound tactics when you can use good sound tactics. When things work really well, you make a lot of money. When things go against you, you don't lose money at least, right? Or you lose a minimal amount of money. That's the equilibrium of risk and reward all by there. All right, everyone. Until next time, no edge, no trade. Cheers, everybody.